In this video, you'll learn 5 safer, beginner-friendly option strategies to make your first $500 to $1,000 in premium income in 2026, using blue-chip stocks and major ETFs only. Imagine this. You're not day trading. You're not YOLOing weekly calls. You're placing 1 or 2 boring conservative options trades a month on big ETFs like SPY and QQQ and pulling in an extra $50 to $100. That's $500 to $1,000 a year from strategies you can repeat. Let's turn options from scary into simple income tools. Welcome back. It's YieldZap Pro. Here, the goal is simple. Make money strategies easy to understand so you can actually use them. Today is your beginner's playbook for making your first $500 to $1,000 with options in 2026, safely and repeatably. Quick disclaimer, options are risky. You can lose money, not financial advice. Always do your own research. Assume you have between $5,000 and $15,000 of buying power. Your realistic goal is about 0.5 to 1% per month in option premium. That's $50 to $100 a month on a $10,000 account. Target: 0.5 to 1.0% per month, approximately $50 to $100 on $10,000. Strategy number 1, cash secured, puts on stocks. You want to own. You sell a put on a stock or ETF you already want to own, and you keep enough cash to buy 100 shares if you're assigned. Best with big ETFs, SPY, QQQ, large liquid blue chips. Looking at late 2025 option chains. On big ETFs, 1 month puts about 5 to 10% below the current price often trade for around $2 to $4 per share. That's $200 to $400 per contract. But that contract controls a lot of cash. For a $10,000 account, you'll usually use a cheaper ETF around $100 per share. One cash-secured put then uses about $10,000 in buying power. If you collect about $1 per share, that's roughly $100 for the month. Example, $10,000 cash. Sell 1 times 30-day $95 put on $100 ETF premium, approximately $100 income realistic target, around 0.5% to 1% per month on your secured cash. So, $50 to $100 on $10,000. Cash secured puts are like getting paid for placing a limit buy order below the current price. Why it's relatively safe in 2026. You only sell on quality names, you hold full cash, and you're okay owning the shares. If the stock or ETF crashes, you still must buy at your strike. You'll own 100 shares at a loss, even though you keep the premium. Strategy number 2, covered calls on ETFs. You already hold. If you already own 100 shares of a solid ETF, you can rent them out for income by selling a call. SPY, QQQ, broad liquid ETFs. December 2025 examples on SPY and QQQ show this. 1 month calls around 5% above the current price often trade for tens to a couple $100 per contract, depending on volatility. With a $10,000 ETF position, say 100 shares of a $100 ETF, a slightly out-of-the-money call might bring in roughly $1 per share, another $100. Own 100 shares at $100. Sell 1 times 30-day $105 call for $100 premium. Again, you're aiming for that same 0.5 to 1% per month. A covered call is like renting out your stock for 30 days at a time. Why it's safer? You already own the shares. The option can't hurt you more than the stock can. It just caps your upside in exchange for income. If the ETF rips higher, you'll have to sell at the strike price and miss gains above that level. But you keep the premium. Strategy number 3, the wheel strategy. Step 1, sell a cash-secured put. If you're assigned, you buy 100 shares. Step 2, you now sell covered calls on those shares. If you get called away, you're back to cash and repeat from step 1. Great with liquid ETFs, stable large caps. For a $10,000 wheel position, each leg might bring in around $100 in premium. 100 from the put, 100 from the call in a good cycle. If you complete 4 to 6 of these small cycles in a year, you're looking at roughly $400 to $600 in income from that one wheel, plus any capital gains and dividends. Wheel example on $90 ETF. Sell $85 put at $1, $100. Assigned, 100 shares at effective $84. Sell $95 call at $1, $100. The wheel is like running a tiny rental shop on your ETF. You get paid before you own it, and paid again while you own it. Why it's relatively safe. You only spin the wheel on ETFs or stocks you'd happily hold long-term. No margin, no naked options. A major drop can leave you holding shares that are far below your break-even. Future call premiums help, but they don't erase a big crash overnight. Strategy number 4. Cash secured puts on SPY/QQQ index focus. Strategy 4 is really strategy 1, but focused on the big indexes. SPY tracks the S&P 500. QQQ tracks the NASDAQ 100. They're huge, diversified, and have very deep options markets. Late 2025 chains show plenty of monthly puts on SPY and QQQ with tight bid-ask spreads and strong volume. A one-month SPY put, about 5 to 10% below the current price, often trades for a few dollars per share. $200 to $400 per contract in normal volatility. But here's the catch. SPY and QQQ are expensive per share. One contract can tie up $40,000 to $50,000 of cash. So smaller accounts will usually use cheaper ETFs or micro-index products to follow the same principle at a smaller scale. Full-size SPY QQQ contracts need large buying power. Smaller accounts use cheaper index ETFs. You're being paid to agree to buy the whole market at a discount if it dips. Why it's relatively safe? You're not betting on one company blowing up. You're tying your options to diversified baskets with long track records. In a real bear market, indexes can fall hard and stay down. You're still buying into a falling market, which is emotionally tough even if the strategy is sound long-term. Strategy number 5, protective collar. Strategy 5 is the protective collar. This one is more about risk management than pure income. You use it when you already own 100 shares. You sell a call above the market to bring in premium. You buy a put below the market to cap your downside. Sell 6-month $110 call for $3, $300. Buy 6-month $90 put for $2.50, $250 net, plus $50 over 6 months. Downside mostly limited below $90. On a $10,000 position, this might only add a few dollars a month in net income. The real benefit is the floor under your losses. A collar is like putting a floor and a ceiling on your stock. You cap both your max loss and your max gain. Why it's safe? It's one of the few option strategies that actually reduces risk by adding insurance below you. If the stock slowly grinds higher, your put expires worthless and your shares probably get called away at your strike. You'll miss a big breakout, but you were protected the whole time. Bonus: getting started, mistakes, calculators. Here's a simple roadmap to start. Step 1. Apply for basic options approval at your broker. You want the level that allows covered calls, cash-secured puts. Most big brokers offer this after you fill out a short questionnaire about your experience and goals. Step 2. Begin with just one contract, one covered call, or one cash-secured put. Treat the first few trades as practice, not income. Step 3. Use an options calculator or built-in probability tools. Many platforms show your max profit, max loss, and probability of profit before you click Submit. Common mistakes to avoid: trading meme or illiquid stocks, using margin or naked options, chasing huge premiums near the money, ignoring assignment, overtrading every week. If an option premium looks insane, there's almost always a reason. Usually it's risk you don't fully understand yet. Simple income sanity check. Take your account size, multiply by 0.5 to 1%. That's a healthy monthly on options income target for conservative strategies. For $10,000, 0.5% is $50. 1% is $100. If you're consistently making way more than that, you're probably taking way more risk than you think. $10,000 times 0.7%, approximately $70 per month. Realistic, repeatable. If you're still watching, you're already ahead of most people who click Enable Options with Zero Plan. Your first goal in 2026 isn't to double your account. It's to learn one or two safe strategies, make that first $500 to $1,000 in premium, and protect your downside so you can stay in the game. Which strategy will you start with? So, tell me in the comments, if you had to pick just one to start with, would it be cash-secured puts, covered calls, the wheel, index puts on SPY/QQQ, or a protective collar? Drop your answer plus your account size below. If this playbook helped, please hit like, subscribe, and smash that bell so you don't miss the next deep dive. Thanks for watching, and trade safely.